what's going on, guys? Welcome back. Marriage, Money, and Mindset. We are your hosts. I'm Jared.
And I'm Alexis.
Welcome back, guys. Episode 23 of Marriage, Money, and Mindset. We want to kick it off with thanking the new subscribers to the channel. Welcome and thank y'all for the returning subscribers. Appreciate y'all coming back and tuning in. If you haven't followed us yet, consider subscribing on IG and on our YouTube channel.
That's right.
Marriage, Money, and Mindset. Okay. So yeah, guys, we back. We doing episode 23 today. Still talking.
Today is part 5 of our series.
Yeah. We've been doing the month of January 2024. We've been doing a series on real estate investing, right? Which is one asset class that we invest in. And so today is going to be the final episode of the series, which is part 5. So hopefully y'all gotten some value out of this series. If you haven't seen the series in its entirety, please go back, rewatch from series part 1 to part 5. It's a 5-part series, guys. Excuse me. So today is going to be about scaling, okay? Last week's episode, we discussed buying your first deal, right? So when you're buying your first deal, of course, there's, due diligence. You need to be aware of how the contract is written out, how to present an offer, things of that nature. That's kind of what we discussed in the last episode, right? So today we're going to be talking about scaling a rental portfolio, guys, right?
Yeah.
Okay. So, of course, we're not financial advisors. We always got to mention that in every episode. So there was the mention. All right. So let's get into it, Hershey. Let's talk about it.
All right. So today we're going to talk about scaling your portfolio or getting more doors.
Yeah.
You want to consider 3 tips. So the 3 tips are strategic property acquisition, efficient management, and financial planning. So you want to talk about the first one?
Yeah. So those aren't the end all be all, but those are 3 great places to start, guys. So what she just mentioned, we're going to talk about the first one being strategic property acquisition, okay? Mm-hmm. So what that involves is researching and selecting properties with growth potential. Let's pause there for a second. Now, if y'all go back and rewatch the episode we discussed on calculating cash flow, our very first deal, that's what we did, right? We researched the areas that we wanted to invest in, and we looked for properties that had growth potential. Now, when we say growth potential, we're referring to a property that has some upside, right? Whether that be added value that you can contribute yourself into the property, or if you can find a property that's listed far below market value. It's kind of how that deal ended up working out. We showed y'all the appraisals. We purchased it. It was worth $87,000. 11 months or 9 months later, year later, same thing. It was worth $156. Upside potential. That's an example, right? So you want to try to find properties that have that potential, guys. Okay.
And not only that, but also the area that you're investing in, because that's one thing
matters.
that you cannot change is where your property is located. So is that area flourishing?
Yeah, exactly. Some people, man, they buy property and make it look like the Taj Mahal, but it's in a neighborhood where the demographics you can't do anything about. Like, the streets are going to be whatever they are. The neighborhood, if it's run down, it's going to probably be run down. Your property looks great, but it's a rundown neighborhood. I mean, just things of that nature to consider, guys. It doesn't matter how much you beautify a home. You want to buy in areas that are, have the potential to appreciate value, not depreciate, right?
Right.
So consider factors, literally what we just mentioned, like location, market trends, potential rental income, and property conditions. So you want to diversify your portfolio to minimize the risk and leverage financing options wisely. Okay, so that's number 1, strategic property acquisition, right? Mm-hmm. So you talked to us about number 2 being efficient management. Let's talk about that.
Okay, so you want to get systems in place for your tenant screening, your rent collection, and your property maintenance. So like us, for example, we use a property manager, and a lot of those systems are already put in place by the property manager. So whenever you're shopping around, if you want to use property management, That's one of the things that you want to shop around for and see how they conduct their business. Because overall, I mean, you want to have a good tenant in there, which you can't really control, but you want to do the best that you can.
What would you recommend for that individual who says, you know what, I don't want to use a manager, I want to keep my 10% fee?
That's
what would
fine.
you say? Well, no, I mean, as far as being efficient with their management, what are some things that individual maybe could consider doing, in your opinion?
Okay, so you can look up some property management software to make your systems more uniform so that you're doing each property that you own the same.
Yeah. So basically just some format.
To keep you organized.
Yeah. Okay. So there you go, guys. To me, it makes more sense to pay the fee, leave that up to a reputable management company to do for you, which, like she mentioned before, that's what we've been doing. But again, to each his own. So, hey, just know that if you're going to go that route of doing it all on your own, like she mentioned, maybe consider purchasing some software that can assist you, with keeping up with everything. Because that's one thing I really do appreciate, especially this time, because we're coming up on income taxes, right? So we're going to have to file income taxes here in a little bit. And our property manager actually sends us an itemized, itemized list of expenses, it's a financial statement basically. So it helps a lot, with keeping up with the, expenses annually.
Right.
It's all right here on one format, like one paper. You just print it, you can bring it to your accountant. Makes life a lot easier versus if we didn't have that.
It's easier maybe to do your own property management the less doors you have, but once you start scaling, like we're talking about in this episode, maybe it's something to consider.
There you go, right?
And the fee won't really hurt you as bad or affect you as much because you have more doors.
Exactly. Yeah. So, of course, like she mentioned, the software or management, just establish clear communication channels with tenants and respond promptly to issues. Regularly review, I can't talk, and optimize your portfolio's performance to maximize returns, right? So, there you go. So that's going to be the second part, efficient management, right? So the third part, of course, financial planning, guys, to scaling your portfolio. This is going to involve budgeting for property acquisition, maintenance, and potential vacancies, right?
That's important.
Yes. So you want to create a reserve fund for unexpected expenses and plan for property financing. Monitor cash flow to ensure positive returns and consider tax implications, right? So let's talk about that real quick. Like, okay, if y'all remember our episode that we did on calculating cash flow, right? We had expenses associated with that property before it was rented, right? So this property one, right? Let me draw it again. Property number one out the gate, right? We bought this property in 2016. So the expenses associated with it, we had principal and interest, which was $388 a month, right? That's our P&I, right? Which stands for principal and interest. That's our financing, guys. And then we also had the taxes and insurance of $335 a month. Taxes and insurance, right? So these expenses, if you're financing, of course, you're going to have a P&I. Taxes and insurance, you're almost always have that expense, right? So now, of course, property management typically doesn't take their fee until it's occupied, right? But let's just focus on these real quick, right? So you got $388 and you got $335, right? So those expenses, we are actually responsible for a total of $723 a month, right? Until this property is rented out. But here's the thing. Even when this property, let's say it's rented out, but then it goes vacant. A couple months later, maybe we get some terrible tenants. Or I'm not gonna say terrible, just a tenant who said, hey, I think I wanna break my lease. I don't wanna live here anymore, whatever the case may be. They move out. Hey, guess what? This is now your responsibility, right? So when we talking about having a strong reserves for unexpected expenses, well, that could be unexpected. You bought a property with the expectation of renting it out. You get it rented out, but then something unexpected happens, like the tenant moves out. That's an example. And just know, now, of course, there's other expenses associated with this property too, utilities, upkeep. We didn't even talk about that. You have utilities, your lights, your,
Any maintenance.
water, upkeep, there's a lawn that needs to be cut, there's grass, got to mow that lawn, right?
Yeah.
So, you add this to this as well. You know what I'm saying? So, and we've experienced both, guys. We bought properties that are vacant, where there was no one inside. And we've also bought properties
that were already occupied.
that were already, exactly. They were already, we inherited tenants, right? And out of both scenarios, what would you say has been the better route in your opinion? They both have pros and cons, but I just want to hear her. She talk on it. Talk to me.
I like whenever we purchase properties that are vacant.
Okay, tell me why.
Because the properties that we acquire the tenants already, they're used to the old property manager. So, we come in and we may do things different. So, however they were doing things before, I don't know.
But my thing is, you're already cash flowing.
No, I understand the pros. I'm just telling you my opinion on what I prefer.
Okay. I didn't know that.
Yeah.
We literally just discovered that live on here on camera. I didn't know that.
What do you
Personally, I like buying properties where the cash flow is already coming in. Because here's the thing, guys. Look, let's talk about a fourplex we bought, right? Okay. 1 door, 2 door, 3 door, 4 doors. We purchased a fourplex, I think in 2021, something like that.
I think so.
All right. Okay. So like she mentioned, there's gonna be the way the old manager did things. Of course, new management comes into play. Well, and the thing about the changes, I don't feel like there were changes made that were drastic.
Not only that, but also who we purchased from, they did their own property management. So, it was some things that...
the old owners, they did things a certain way, so maybe these tenants became accustomed to how they operated. But again, guys, look, we're already cash flowing day one, right? So those expenses I shared earlier, P&I, taxes and insurance, principal and interest, day one, there's income coming in from each door, right? Day one. So if one of these tenants don't like the way the new management is, well, guess what? Okay, cool.
Still
Maybe
75% occupied.
Exactly. With a fourplex, well, we're still 75%, 25% vacant. Cool. No problem. And then, of course, that gives us an opportunity to now go into this property, maybe consider doing some upgrades, right? Maybe we weren't even getting the rent we felt justifiable with this unit out the gate, right? So it gives us the opportunity to go in, do some renovations, make the property a little bit more modern, right?
Well, that's another thing that I dislike about acquiring tenants is you have to wait until a turnover to go do what you want to do in the property most of the time.
But if you've done your calculations right and you're going to generate a return on that investment that you're happy with, well, you can only expect a greater return later. After the renovation. That's been the story for us, guys. So I was going to mention, maybe this tenant got upset with the management, didn't like, well, for whatever reason. Guess what? Okay, cool. They move out. We get an opportunity to go in and modify the unit, make it a little bit more modern. And this is what happens next. Well, you get the next tenant in there, and now you're bringing in even more cash flow because you can justify the rent increase based on the renovations that you've made. So maybe you're getting, $1,200 a month for this unit, but after the renovations, and now it's modernized to more comparable rates. Well, now maybe you can get 1350 or even 1400 a month, right? And justify that because of the renovations, right?
Yeah.
Just something to think about. So there's pros, there's cons to both. Buying occupied, but the idea, guys, when you're buying an investment property, it's the cash flow. If you're buying it for a long-term investment to generate income, okay? So let's keep it moving. Let's talk about some of the cons for having one door, all right? Because we know a few folks who have one, and this could be an issue, right? So having one door, to me, it's extremely riskier simply because you're either going to be 100% occupied or 100% vacant, okay? So with one door, it's harder actually to earn a positive passive income. Again, for that reason I mentioned earlier, you'll have your all-in cost when you purchase the unit, your down payment, your closing fees, right? But every dollar that you put out of your pocket into that investment increases your cost base into that investment, right? Meaning that your return is actually
Decreasing.
It's decreasing because you're putting more money into the deal, right? So you want multiple flows to weather those storms, expenses when they occur. Like we just gave the example of a fourplex, one unit going vacant where we're still 75% occupied.
Right.
2 units go vacant, we're 50% occupied, etc. Right? Mm-hmm. So that's something you want to definitely, if you're going to get in this business, guys, highly recommend scaling it simply because, at least for us, it's helped all of our other endeavors in life.
Right.
Being able to, do things that at a faster pace than what one door would do, right? Because only, when you have multiple doors building up equity, every single month that equity is being built up due to the pay down, if you're financing, of course, due to the pay down that tenant, the rent that comes in, a portion of that goes to the principal balance and reduces that principal balance that from your lender. And that increases your equity, right? And if you invest the way we do, where you use leverage and you tap into your equity, also appreciation, guys. We didn't even really touch on that.
Right.
But appreciation is also another form of equity that you can take out. You just have to be careful when you tap into that because you don't want to over leverage, right? Meaning that you have too much principal borrowed out and the income that property generates is not enough to where you're making a positive cash flow, right? Because even with that first example, if y'all go back and watch it, notice our P&I increased when we took out the cash flow, the equity out of our first property.
Right.
The principal and interest payment increased because it was a higher principal balance taken out. But of course, we bought 2 more properties with it, and that brought our income right back up and then some, right? Yeah. So just consider that as well if you're going to tap into appreciation when you're doing like a cash out refi. It's all about the numbers, man. It's all about the numbers.
Remember, we met Jamal King.
Yeah.
And he's a real estate guy out of Chicago. Mm-hmm. His thing is, I need a building for every bill.
Yeah, I remember that. Yeah, I like that.
So that goes back to the multiple streams of income. Mm-hmm. If you only have one drip of income, what happens whenever that gets shut off? Well, now you have to supplement that income some other way.
Yeah. Here's a cool example, guys. Let's just say if your dream is to have a positive cash flow of $5,000 a month, all right? Mm-hmm. That's your goal, $5,000 a month. Okay, cool. You could probably buy a fourplex and pay it off and it'll do that. But again, let's talk about leverage. Let's say, okay, if I can positive cash flow a door $300 a month, well, obviously that's going to be about 16 doors, right? To do that. Now, how much is 16 doors going to cost? Well, it depends, right, on your market. Usually the type of properties we purchase usually end up, well, that's actually 4,800. All right, 300, that's 4,800. Close enough though, right? Okay. That can be a monthly income, 16 doors. Okay. Now, the whole point in that is you have multiple doors. You're probably not going to always be 100% occupied also, guys. That's another thing to think about because let's say, I think we're probably, I would say 100% occupied, maybe 90%.
85, 90%.
Like right now, currently today, we have one vacancy. So we're 90% right now, right? So yeah, on average, but that's a good ratio. You want to have, on an annual basis, definitely over 50, 60% vacancy. Occupancy, not
Right.
vacancy, right? So, and that's been the trend for us, since like I said, we've been doing this since 2016, so late 2016.
Yeah.
Yeah. But that's another reason scale, so, and then like you're talking about 16 homes, man, you're building equity every month in those 16. Like 16 can turn into, what's double that? 32 quick when you're talking about tapping into that equity
Right.
every so often, the appreciation as well, if you can afford to, and taking that equity and rolling it into other deals.
The goal is financial freedom.
Yeah.
So we've talked about that in a previous episode or a couple episodes. So hold on just a second. So just this example, the more doors that you have, the more passive income that's coming in, that's getting you closer to your financial freedom number.
Right. Yeah,
so that's the whole point.
And it's just good to diversify. Have you some real estate.
Excuse me.
My bad. Have you some real estate. Have you some stocks, some shares in companies. I'll say that. That's the way we invest in the stock market. We don't invest in the stock market. We invest in companies in the stock market. We have shares in companies. So if y'all confused about what I just said, go back and watch that series, right? And some crypto, Bitcoin. Y'all buy some Bitcoin, man. It's not financial advice though, but just buy some Bitcoin. Yeah, but let's talk about this real quick, guys. So look, I will mention this. In order to scale, you do need to be very responsible with how you manage your financial statement and balance sheets, right? Not just on the business level, but your personal life. Because how you do one thing is usually how you do another thing in most cases, right? So if I'm a terrible individual with my own personal finances, like
you're a bad manager of money.
Yeah, I'm not keeping up with.
You're always late on bills or
right.
spending too much.
And then not to mention, lenders usually can point that out as well. Like your credit report is like your report card as you're an adult. You know what I'm saying? Like what your GPA was in school doesn't matter when you become an adult. When you go into the bank, not one time have I gone into a bank or credit union and they asked me for my report card or GPA or any of that. They always want to know. They want to see my credit report, right? So that's a display of how well I am, when I do borrow money, when I use credit, how responsible I am when I make payments back, things of that nature, right? So you definitely want to be a good financially in order to be good financially in business, right? And that goes for any business, not just real estate investing, any business, in my opinion, guys, that you want to, right? You have to be a great, individual who's responsible in order to be a great business owner. You know what I'm saying? So that's just some other things I wanted to mention. You have any comments?
No, also staying organized. That goes with what you were just saying. If you're not organized in your personal life, then you may need to tighten up on that skill before starting a business.
And that's a good way to practice. Practice with yourself first, Practice with your personal
development.
Personal income and expenses we all have them. We all have some personal income and expenses. Practice with that first, right? See how well you can juggle that, because all we're doing is spinning a bunch of plates. You know what I'm saying? So you don't want the plates to start falling. You know what I'm saying?
Look at these analogies.
All day. So yeah, guys. So yeah, that's pretty much scaling a portfolio. We're going to continue to scale our portfolio. You know, I want as many doors as possible. And of course, using leverage, that's going to help us get there. You know, capturing equity out of our properties because that money's not working in the property, guys. Use leverage. Just, again, debt's not bad. It's how you use it, right? Of course, you know, take the cash flow, reinvest it in other assets, you know, such as like the stock market or your personal business or crypto to help continue to grow or grow your nest egg. You know, reinvest, leverage your stock portfolio if you self-direct your own brokerage, your own stock portfolio. That's a way to help scale. That's actually what we've taken advantage of in the past. You know, just get creative with your financing. Speaking of creativity, guys, that book that we've been talking about this whole series. From episode, you know, whatever to where we are today, part 1 of the series, we finally found it. It was in Hershey Court last time. What happened the last time? I was just too lazy to grab it. It was at the top of our little bookshelf here. But this is the book, guys. So look, it's called The Millionaire Real Estate Investor by Gary Keller. Highly recommend this book. Of course, I rewrote the book like I always do. Have my own personal notes as well in this book. From what I can remember about this book, it's like a manual, you know, to how investing in real estate, A to Z, you know, what the things you need to know. Man, it's all in here, guys. There's another one for agents, I think, too, The Millionaire Real Estate Agent. Highly recommend it, guys. This book was $25, right? Just like The Richest Man in Babylon was $9.99. This book has way more value than what it costs.
Right.
The investment was well worth it. So until we write our book, y'all go get this. I'm gonna show some love to Gary Keller. Y'all check it out, man. I highly recommend that book if you're wanting to invest in real estate. It'll definitely help you along your journey, right? Mm-hmm. Yeah. So that's pretty much all I have left about this series. You too?
Me too.
Yeah. Well, there you go, guys. That's the real estate series for Marriage, Money, and Mindset. So guess what? You know, next month is February. We coming up on the month of love, right?
Right.
So we're going to do a 4-part series discussing love. You know what I'm saying? Love and happiness. You know what I'm saying? How to keep that marriage or that relationship, you know,
Keep the flame lit.
Keep that flame lit. We don't want to blow that. We don't want to blow that candlelight. Keep it burning hot. You know what I'm saying? So yeah, we gotta teach y'all a little something about keeping that flame hot. So stay tuned for that, right? So yeah, thank y'all for watching. Like, share, subscribe, comment. Come back, tune in, show us some love, man. You know what I'm saying? And we're gonna keep doing the same. We're gonna be consistent. Y'all be consistent too.
That's it.
See y'all. All right.
Peace.
Peace.